Good morning, everybody. It is October 25th, 2019, and we are going to talk earnings today. We're going to fly through this in hopefully exactly 1 hour or less, and I will take a lot of questions. Keep it to stuff on our very short lists. I'm not always up to date on companies that we don't follow, the 80 or 90 or 100 or whatever it is that we have on our short lists. So keep that in mind. But let's start with Amazon. So Amazon is in the news quite a bit today. I had it up here just a second ago. All the tech companies are subject of quite a bit of interest as they are some of the most heavily invested companies, and they drive both the QQQ and SPY/VOO. Amazon got whacked last night and is continuing to get whacked today, down $44 a share. Of course, we've sort of been expecting this. Amazon is one of our shortlist companies. Bullish support here, just under $1,500 a share. But bottom fishing is probably a shade under $1,300. And the question becomes, is a drop of $44 today enough to make you jump in? It is not enough to make me jump in. One of the things I would point out, though, is that the monthly investment in Amazon has been falling off a cliff here in the last several months. So a lot of people are dumping their Amazon shares. Yet we know there are some very, very, very big buyers out there. Mark Cuban said that he had nearly $1 billion invested in Amazon. So he's looking for some pretty, bright things on the horizon. What would those bright things be? Well, their advertising business is growing like crazy, and we have talked about that for the better part of a year now. So I like that they are getting into the entertainment and the advertising. I really didn't watch much TV until I started dating again. So, we have our TV time together, and we've been comparing the different services. There's going to be a lot of profits spread out here. The customized content, the different types of shows that are out there, really are pretty amazing. If you watch Amazon and Netflix and HBO, which is part of Warner Brothers, which is part of AT&T, there's a lot of content out there. Sony is still out there, and I still expect them to sell their entertainment division at some point. But you take a look at what Amazon's doing or what AT&T is doing, which is also another one of our holdings. AT&T we own. Amazon we'd like to own again. The question becomes, how much money is there to be made? And the big diversification of entertainment and content that we've seen over the last 10 or 15 years appears that it's probably going to contract now down to a half a dozen companies. So while content is still king, it looks like the throne has been bought. So who's going to own that throne? It's probably going to be about a half a dozen companies making all the money. It's going to be Amazon. It's going to be Netflix. It's going to be AT&T. It's going to be Disney. Whoever ends up owning Sony, Apple, which seems like a logical choice to buy Sony's entertainment division. They just don't typically do that. But if they want to really break into content, that's the logical transaction in my mind. So you take or they cut a deal, to share the content. So where does that leave Amazon, a company that just grows and grows and grows to the point where, during this buyback bubble that I've been talking about, who hasn't bought back any shares? Amazon hasn't bought back any shares. So ask yourself a question. What if we get a bit of a recession next year or economic slowdown? Valuations come in, stock market gets that 20 to 40% correction that I think is going to happen next year. Amazon will be in a position, having already grown, established position, that they can cut a lot of their expenses again. And if they really wanted to, they could put it into share buybacks or a dividend. I don't know that Amazon will ever pay a dividend under Bezos, but the grocery transaction of a few years ago with Wholesale Foods tells me that ultimately Amazon matures and they just become a cash flow machine, much like Google and Facebook and Apple. Well, we already have seen Apple started paying a dividend and returning cash to shareholders. I think that is on the horizon for all three of the other companies, Amazon, Facebook, and Google, Alphabet. Although I think Alphabet will do it in a slightly different way. I think they're going to spin off a lot of companies, the baby Googles that we've talked about. And Amazon will probably end up buying back shares and paying a dividend eventually, and so will Facebook. They really don't have much ability to grow all that much more in their core businesses. The cloud business is going to continue to grow for the better part of a decade because of edge computing. We now know that Google has basically conquered the first level of a type of quantum computing. They're not going to get the million times faster, but they've announced, and it was in the Journal of Nature, that they have the 10,000 times faster computers. So edge computing and everything that comes with it, with no latency communication via 5G and whatever is after 5G, is going to change how all of these companies operate. So I think that if you are a dividend investor, you need to stop looking at the 5 and 6 and 7% dividend yielders out there. They have the questionable balance sheets and they talk about their past. Look forward, and you will see several companies staring you in the face in Google and Amazon and Apple and Facebook that are going to be the big dividend payers of tomorrow. Now, do they have some transitions to go through? Yes. Is there going to be choppy parts of the economy? Yes. That's when you buy them. You buy them when they get beat up. So I would take a look at those when you get a chance. I think Amazon, I think I have this. There's no shortage of everybody wanting to talk about things. So the fact that we can cut through it in 2 minutes, I think is not bad. If you want to see what every analyst is saying about Amazon, go ahead. I wouldn't bother subscribing to CNBC Pro. I've had it. Meh. I have a bunch of subscriptions. I don't have that one. Let's jump back to the Dow Jones Industrial for just a second. Actually, I take that back. Let's stick with technology. Microsoft, they are going to probably start chopping along here for a while. Azure went through that huge growth phase, and they still maybe have a giant government contract coming, but again, they're probably just going to grow with the industry. There's competition in cloud now between Microsoft and Amazon at the top, but then you have several chopping at the heels, including Google, and don't forget about IBM. So the margins on cloud and the growth on cloud will be spread out a little bit more than in the past, right? Getting a diversification, getting competition. So that's not really where you want to look for the biggest money anymore, but it is a secular growth trend. So you want to be in it, but don't look at these as home run, 10 times your money stocks. These are just stocks that are going to beat the market, right? And that's what you want. So when you take a look at the balance sheets of Microsoft and Google and Amazon, and you say to yourself, okay, these are companies that are growing ahead of the economy. That's going to go on for probably a decade or more. Even if Elizabeth Warren becomes the president, there's not a lot she can do to these companies because, in fact, Google is already set up to split itself up. And some of the other companies, I think, make pretty legitimate arguments against being monopolies. Even Facebook, which I'm not a big Zuckerberg guy. I think he's kind of weaselly, and I think he just refuses to see the world as other people see the world, which is good and bad for him. But I think ultimately Facebook chops along for a while until they deal with some of their monopoly questions. But what do you think is going to happen? How do you break up Facebook? Do you really try to regulate it as a utility? It's social media. You know, we saw MySpace disappear. We saw Google fail in social media. People are going to Facebook because it's convenient, because they're already there. It's got inertia, you know, it's got momentum. You know, Twitter, we saw their earnings get crushed today. Their yesterday in the stock drop. I don't see a natural competitor to Facebook, regardless of what the government does. Could they be told to spin off some of the things they bought? I don't even know if you can do that. They all seem to fit together like good pieces. Ultimately, that drives Facebook to start giving money back to shareholders because their growth will be limited just because they're so saturated. But also, I think we have to take a look at what the government allows them to monetize. And if they can't sell data anymore, which they're really backing off on, they do it in a backdoor way. We've talked about this in the past. You know, then you have a company like Facebook that, you know, again, their earnings will be limited because government's going to limit what they can and can't do, but they really just can't be broken up. So they'll be one of these companies that turn into a cash flow machine. They already really are. It's just not going to be the type of growth that they've seen in the past. Clearly, Zuckerberg, if you watch his testimony, is trying to capitalize on this election, though. And he wants to make a lot of money on this election. And again, the weaselly thing keeps coming through. So if we take a look at some of the charts, let's go back to Amazon real quick. Why do we talk about the price levels we talk about? Well, this area in here, this flat area in here, you know, you're looking at about $1,100 a share. Don't discount that this could happen. I just don't think it's all that likely. But ultimately, this is, you know, just under our bottom fishing range. If it really got down here, you'd have to back up the truck. There's big institutional buyers, though, which is why I look more at this level. These are big hunks, so that's why they're monthly charts. That's why I look at this level right here. Is I really want to buy in here. So where the cursor is now, covering, if we get down to the upper 1200s, again, I think I just have to buy a lot of it. If it goes down to 1100, I just hold my nose. Then right in here, I guess it could hold. You know, we could hold this 1500-ish area. You know, I don't know. Again, you know, I'm not generally risk on right now. Generally, I'm risk off. But you have to consider what you're willing to pay for the future. Microsoft has been going up and up and up and up and up. Again, they have a couple of different levels where you could see them fall to. Down in here, I suppose it could happen, right? Happened at the end of last year. So if Microsoft fell into the 90s again, I think you have to back up the truck in this area. Can they keep growing the way they've been growing? No, because the cloud market they broke into is no longer new. So the hyper growth period to get Azure off the ground over the last several years and make it a powerhouse, that's gone. Now they're just going to grow with the industry. So if we get the general pullback in valuations that I've been talking about, right? The revenue growth is in the teens, but the PE ratio is in the 20s. That means that the PE ratio, right, if you think about PEG, for growth stocks, you got to think about price to earnings to growth, should come down. And if this comes down too, this will come down as well. So with a price to book value that's way high, we don't have to worry about their balance sheet. They're one of those companies with just boatloads of money. We have to consider what we're really paying for. And Microsoft, down under 120, you probably got to start thinking about it. But then down around 100, I think you really got to start shoveling it in. Now, what if we give back all of the gains made under Trump for these tech companies? That's not impossible. And as an investor, you have to consider what you're willing to risk. Let's take a look at the SPY, just on the big picture. Five years ago, S&P 500 was right around, that correction range that I keep talking about, that 220-ish range. 3 years ago. And we've had this rally, which was really early in the Trump presidency and not in the last year and a half. In the last year and a half, it's been in this range, right? Not much higher now than it was at the start of 2018. Came off, got a slightly higher high, big December correction, slightly higher high, slightly higher high, slightly higher high. I showed the other charts in our quarterly review. This is indicative of a topping process. So down to here, I think, is a virtual certainty. We'll see the levels we saw last December again next year. Maybe the end of this year, but probably not. Why probably not? Because when a market is up in a given year, there's very rarely selling at the end of the year. People ride the rally out. They defer their gains to the next year. So you'll start to see the big money moving away from the market heavily, probably in the first quarter next year, because as we've talked about, earnings expectations, as we'll keep filtering through, are not that high. The trade war, even though we just got a headline that they had, it looks like they're signing phase 1 of the deal, only really brings agricultural trade back to where it was 2 years ago. So, we've got this hole that we have to fill. But who is that good for? And who is one of our bigger holdings? Hey, Nutrien. So Nutrien's been chopping along here. We've been collecting our dividend. Let's take a look at where Nutrien is. Day traders hate it, right? Money flow, day traders hate it. Chopping around in the middle of the market. But what does the big money think? No, it doesn't go back that far, dang it. Because of the merger, that's gone. The big money has actually been, you can tell from here, just do these at a monthly interval. The big money bottomed out back in here at the end of last year and has been trickling in. So Nutrien, with its 3.5% dividend, and now the trade deal that's going to go straight into agriculture, basically. I think that this is one that, I mean, you should be buying under 50. Gets under 50 pretty often the past year. I don't think that lasts much longer. I think we're going to see this rally break out again. And ultimately, I do think Nutrien is probably a $100 stock because of their oligopoly pricing power and ability as the largest producer of potash in the world and one of the largest producers of all other fertilizers, and very difficult to enter those markets, right? Big barriers to entry. At some point, they have a massive rally. If you go out and pull the old charts from Potash Corp, they had massive rallies 8, 9, 10 years ago, right after the financial crisis and then before that. So I would expect fertilizer to be a pretty safe bet. You know, if you are a retiree, I mean, the price has been between 44 and 56 for over a year. That's pretty low volatility while you collect your dividend. And by the way, and I'm going to put out, so I'm going to do the put selling article every Monday now. This is one that you can sell puts on because there is some premium in it. All right, Google announces in a couple days. Of course, if you've been looking at the headlines, where can we get the headlines? They had their quantum computer announcement. They had their announcement on potential of increasing revenue from advertising again because they had a lull. I would expect that Google will disappoint on the advertising revenue. I know that they are pushing hard because they're even soliciting me. I mean, I'm getting phone calls and emails from a Google rep in Phoenix. Hey, we identified you as somebody who could use our service. I've never gotten that before. Now, have I grown a little bit? Not really. In the last year, I haven't grown because I had the oil debacle. But I've been on the web a long time, and it's a viable business, and they think they can get a check out of me. Well, if they're pushing advertising with cold calling now, or semi-cold calling, right? They're using their AI. Oh, that's what they announced today. Big changes to the search engine with AI. You know, they're probably going to see increasing advertising revenues, but I don't think it happens just yet. I think that probably they go through the same lull everybody else does in the next year, but they come out of it strong. So what does that mean? It means that we want to find the spots to buy Amazon. Google, Alphabet. A couple of different levels to buy it. This is probably never going to happen again. So this long line here, where it starts to rise, and this is the one that you want to take a look at. Could Google get down under 1,000, down to around 900 again? They could. And if it did, I'd be backing up the truck. However, you see all these bottoms that look like they hold? You know, you have to look at those too. So Google around 1,100, 1,050, 1,150. You know, hard to split hairs there. You probably have to look at it. I have my limit orders set at 980, but I can move those up or down. Take a look at the longer term chart here. Right, this is emblematic of a topping process in a broad market, but it's a consolidation for a single company if you like the outlook. So outlook is really what determines, is this a topping process or consolidation? I think in Google this is consolidation. I like their outlook. I like the baby Googles coming. So, you know, I'm a buyer around 1,100 probably. I'm going to try to be greedy and get it down to 1,000-ish. And if we do get hit real hard, you know, maybe we can get it down around 900 or 850. Could be. Hard to know. That's why there's no automatics. all these guys out there with the automatic systems, with the magic algorithm, you have to combine technology with analysis. So I invest a lot of money in both. Not only do I invest in a lot of research services, right? You can see I use Zacks, right? It's awfully good. I don't know that I love their recommendations, but their system for tracking earnings expectations, it's a must-have. Right? You don't need all their newsletters. I don't. I just have a very simple subscription. I want to know what the analysts are saying, and I need a way for it to be easy to follow. Zax does that for me, and other services do it now too. In fact, Seeking Alpha is getting pretty good at tracking earnings expectations. So I will throw out a pitch here, and I'm not really in love with Seeking Alpha. They do some things that confound me, like taking over a day to publish my article. But their earnings tracking is pretty darn good. So I would subscribe if I were you. And I actually have their premium service. Right now it's turned off because I haven't written an article in a month. If I write an article once a month, they give it to me for free. But I miss it when I don't have it. So the premium service here with Seeking Alpha, I'm telling you, it's worth the $19 a month. It should be part of your media that you purchase, along with Bloomberg, Wall Street Journal, Financial Times. 2 out of 3 of those probably. If you have time to read all 3 and you're interested, buy all 3. I like Financial Times because it gives me company reports, but I'm going away from even needing those anymore because there's so many out there. And what we've done is obviously we have taken the company report and we've broken it down into SWOT analysis to make it real easy, right? So what we're doing is we take all these other reports, we break it down and make it simple. In a couple thousand words, this is everything you need to know about the company, the strengths, right? The weaknesses, what are their opportunities, what are their threats. If you want to make a smart decision about a company, get to know it. So we are condensing that in here. And I don't understand why we're one of the only ones doing it. We might be the only ones doing it. But these SWOT analyses that we do, I actually have a complaint from somebody who rated me a 1 star who says, yeah, I don't like all the SWOT analysis. It's too much to read. Well, we took hundreds and hundreds and hundreds of pages, got it down to a page for you, bullet point. I don't know. I don't know why somebody would be irritated with that. But we do that with all of these companies. We have most of the very short list has a SWOT report now, and we're working on the rest. So let's go to another company that we're interested in, Intel. I have an interesting bet with somebody about Intel that would be over $40 a share, I think is the bet. By the end of this year, next year, I don't remember. One of us is buying dinner for the other one. Micron had something to do with it too. Both of these companies, Micron and Intel, are at the heart, the guts of the AI and machine learning revolutions. So you really have to take a look at, okay, even if they're not the huge growers that they used to be, what are they going to be going forward? Well, the big secular trends are in those directions that we've talked about. The same sorts of things that Kathy Wood identifies over at ARK Investments. Intel's, even for all the times they get in their own way, good company. So they, right, jumped up a little bit on earnings. Would I buy them in here because the earnings, right? All these folks who are buying today, they're looking backwards. Look forwards to the next year and 3 years and 5 years. And you can kind of think about 10 years, but the 10-year time frame, you just want to identify the secular trends because you cannot forecast out any company 10 years. You can hope, but things change quickly. CEOs leave, CFOs do stupid things, chairmen screw up, right? Ask Elon Musk. So even though Elon Musk is on the right side of history, you can't guarantee what's going to happen at Tesla. Why do I bring up Tesla? You guessed it. Let's talk about Tesla. Let's close some of these so we don't get the blurry screen. So, Tesla is profitable again. How long will it last this time? Well, as I've said, I think Tesla is going to $1,000 a share. However, I think next year will be rough for them as well. Their expansion into China will not happen as fast as they optimistically talk about. How do we know that? Because every time Tesla breaks into something, it takes longer and costs more than they said it would. That's just their MO. You can call Musk a liar. There is a Lusk in Europe. He does something else. You can call Elon Musk a liar. He's not. He's telling you the future. And like Warren Buffett said, I could tell you what's going to happen. I just can't tell you exactly when. So people get all bent out of shape based on the roughly when versus the what. Well, what is going to happen is Tesla is going to continue taking market share. And they're going to get into Europe a little less than people thought. Already seen those numbers in was it Norway? Not being so good. But they're breaking into China, and they're going to end up breaking into India, and they're loved in the Middle East. In the United States, you ask any millennial what car they'd like to have if they could, and you're going to get the leading answer is going to be Tesla. Every study has said the leading answer is Tesla. It's just a matter of what the percentage is. But it's usually a gigantic percentage. I would love a Model X. I'm not paying $110,000 for a car. When it's 50, 60 grand, I'll probably buy it. And it will be 50 or 60 grand whenever they change the battery technology, which we've talked about. On the short side is 2 years. That's the Musk projection. On the long side is 6 years. That's the Kirk projection. So somewhere in that 2 to 6 year time range, battery technology will take another gigantic leap forward. And Teslas will come down 20, 30, 40% in price. And they will be exactly the same price as an internal combustion engine car. So, internal combustion engine cars. Who's about to get their butt kicked in that? Ford and GM. Ford just had a hiccup. GM is fighting with their unions specifically and closing plants specifically because they see it coming. I'm telling you, the GM Tesla merger looks more and more real to me every single day. Every single day. And probably by the time it happens, Tesla is the bigger company. But Musk wins. Think about how businesses develop and think about the smart things that can happen. Things that make sense usually happen, especially when the executives get what they want. What does Mary Barra want? She wants GM not to go to hell. Easy. What does Elon Musk want? He wants to change the world. He probably doesn't want to be a CEO for this company anymore because it's becoming more and more of a regular company, right? It's becoming norm. It's not there yet, but it's going to become a normal company. Does Elon Musk strike you as the kind of executive that wants to run a normal company? No. What does he want to do? Somebody put it up there. What does Elon Musk really want to do? What was just in the news today and happened with Virgin? Damn right. Elon Musk wants to get into the next revolution, which is space travel. Now, that's going to take the rest of his life and ours. He can diddle with space forever. It will never get old. Electric vehicles, in 10 years, they're going to be outselling ICE vehicles. Guaranteed. Guaranteed. I don't guarantee anything. I guarantee electric vehicles by 2030 are outselling gasoline cars. For a lot of reasons. One, the cost is going to come down. Two, the cheap energy from solar, which we already see happening, right? Coal power plants are getting replaced with solar right now. Three, there's going to be legislation or limits carbon, right? No, I think GM keeps going down. I think GM gets under $10. So, switch over here. Yeah, battery technology is already almost there. Toyota on their hybrids just upped the guarantee on a hybrid battery from 8 years and 100,000 miles to 10 years and 150,000 miles. They're going to start guaranteeing these batteries, basically forever. So, GM, let's take a look at the 10-year chart. I think you see GM around 20 in the not too distant future. That will drive their market cap down to about $30 billion. Tesla, even if the stock doesn't move, is already worth more than GM. Barely. I'm telling you, this is going to happen. I would virtually guarantee that this happens at some point. And people will hate it. But it makes so much sense. GM can shrink itself in the short run, which it needs to do. Or they can go into massive, massive debt to catch up to Volvo, to Toyota, to Tesla, to BMW, right? They screwed up. GM screwed up. So now they're going to pay the price the same way that Exxon and Chevron are going to pay the price. They fell behind. It's too expensive to catch up. So you shrink and you break up and you engage in mergers and acquisitions. That's what's coming to all these dirty companies. Speaking of dirty companies, we talked about oil this week, right? I put out the article on cash secured puts to sell. I do think there's another bull market in oil coming because I think supply is going to be limited. There was an interesting article on Bloomberg today. I don't think I have it up here right now, but maybe I can find it for you. But the oil companies' stocks, their earnings are all going up. The ones that we follow. There's a lot of companies, 2/3, 3/4 of the oil companies, they're never going to recover. But these companies that are focused in the Permian, and then some of the rest of the shale, have a great setup happening right now. You probably have a Democratic president who's going to limit oil supply. Why? Because she, and it can be Biden too. Everything leans towards Warren at this point, but we'll see. It's a long process. Either way, the Democrats drive the price of oil up. Why? Because they want to see a transition to clean energy. And that's how you do it. So you get rid of coal, you force that transition. I was just talking to the Biden campaign, right? Because they invited me to a fundraiser. And I said, I can't go. They want me to go to Des Moines. I said, let me know when you have one in Milwaukee. I'll for $100, I'll listen to what he has to say. And I think it's usually what the chicken breast costs. And I said, look, focus on three things. Pound the public option on healthcare. Let Medicare compete, but don't mandate it. And then let the market decide what they want. Let people vote with their dollars. Fair enough. 2, get rid of coal. Focus on getting rid of coal, not a Green New Deal that's too expensive. Focus on getting rid of coal. That would be a catalyst to everything else developing on the alternative side. Make sure you provide loan guarantees to utilities so they don't have to worry about having a problem, right? So they can smooth out the process and remain utilities. Utilities really are going to control the grid for the rest of our lives, even as it becomes less centralized. They still are the linchpin to everything. So there will be private companies that come in and run microgrids, but the utilities probably have a large role in that. The die has already been cast. You've got some of the richest people in the world pushing it in that direction, like Warren Buffett. So, in any case, I wrote the article, right? Short interest in oil is really high. The oil stocks are incredibly highly shorted. And we're probably going to see the price of oil go up in the next few years. Yeah, people are talking about tax loss selling for the Permian players. I think you've seen most of that. We've looked at all the charts; they're all bottoming out on the money flow. So if the money flow is already super low, that means the selling already happened. That's what drove the prices down in the first place. The people holding on to these stocks, I mean, yeah, you're going to get a few people, but look, the weekly chart is rising. People are buying. They sold back here. This is it. This is the giant sell-off. Now, that doesn't mean we can't get a pullback, right? But we got the fake trade deal today, the first phase of the fake deal. And that's going to be good for these companies, right? Oxy's up a little bit today. That's ahead of the market, right? The market's not up a whole percentage point, is it? And kind of, I tell you, this one's just a bargain. Unless what's going on in Oklahoma is truly a massive problem, right? If Newfield snookered them, then maybe Encana doesn't rally. However, I'm fairly certain that they're still going to grow more in Oklahoma than Newfield would have. And their Permian assets are valuable, and they have all sorts of other assets they're trying to sell. And they're getting bids. So as the price of oil drifts up in 2020, and 2021, and 2022, because of supply issues and because demand is still slowly increasing, I think that they do pretty well. It's not risk-free. Nothing is risk-free. I like that Parsley bought Jagged Peak. See, their monthly has always actually had some institutional interest. Why? Because like I talked about in the article, everybody thinks that Parsley is going to get bought. And to me, this is the company that Chevron buys. That'd be my guess. Devon Energy's been talking about a merger with somebody for a long time. We'll see if that ever comes to fruition. I still think it's Marathon Oil. I got some people who know some people, and they say it makes sense too. Chopping along the bottom. So unless oil disappears in the short run, these stocks are just too cheap for how much money they're starting to make. You know, their debt's coming down. They're paying dividends now. They're buying back shares. Price to book value. I mean, take a look at that. And the book value is going to go up when the price of oil goes up. So unless you believe the price of oil is going to stay down here forever, you have to believe that these stocks rally in the next several years. To that end, I think selling puts, to the extent it fits into your asset allocation on all of these, to reduce your cost basis on things you already own, or to add, and this is the basket of 5 stocks that I like Occidental. Why? CO2. And they just had an announcement about solar, right? They're powering their oil fields in Texas with solar. How much longer does it take before they're actually selling solar energy? Not too long. This is the market being stupid. Investors are imbeciles for thinking that the mergers and acquisitions are bad. Imbeciles. You're condensing the control of supply into fewer hands. So unless demand falls off a cliff quickly, and I'm saying in 2030 demand starts to go down in oil, and I'm 10, 20 years ahead of everybody else, except for Tony Seba. You know, this is obnoxiously low. Occidental for sure goes back up into this range, 60-ish. And I think they probably get to 80-ish. And there's a possibility to get to 100-ish if they just keep on buying back shares, which they probably will. The return of cash to shareholders is going to be massive. We just looked at that article a week or two ago. I think it was from Goldman Sachs, right? Devon Energy, and then Pioneer. Why do you like Pioneer? Lowest debt company out there. In the Permian, a pure play. They're starting to pay a dividend, and it's going to grow quickly. So when these dividend growth rates are 8, 10, 12, 15% per year, which is what they're going to be, and they're buying back shares, and they're wiping out debt. Shareholder yield, that's the magic equation. Look it up. Shareholder yield, we talk about it all the time. Companies that grow their profits and then turn that into debt reduction, dividends, and buybacks. And you know the buybacks will continue because that's how the CEOs make their money. All right. So last week, we'll hit on a couple other companies. Okay. So somebody asked about PayPal. Same story as always. They're on the right side of the long-term trend. They're a leader. The competition is proven to not be catching up. So they fell back, and now they're jumping back up again today. I bought these guys right after the IPO. And I got a nice ride up to around 100. I actually was selling in the 90s. I have a couple token shares. This just looks like it'll come back to 90-ish to me. I could be wrong. But I think in the next year, when things slow down a little bit, and these guys have to continue transitioning into the new world of mobile money and electronic transfers, and they have to figure out a way of monetizing Venmo, I think transition is an opportunity. So I think this stock probably comes down to around 90, and then we buy it again. But ultimately, because of the blockchain world that's emerging, and think about this, somebody mentioned it on our chat board. Hey, and I would encourage you guys to get more active on the chat board. Some of the people who left for fundamental trends, I'm going to offer them some sort of a dual matter of fact, I might even offer it to everybody. I might let people belong to both websites who want to get the swing trading that we have at Fundamental Trends. I'll figure out a way of making that super cheap so that you can keep margin of safety, because I know you like it, but then add the swing trading over at Fundamental Trends. So all the overlapping things you won't need, which is 90% of the website's overlap. But the swing trading we're going to bring back. And I think it's going to be pretty interesting to take a look at some of these trades. So if we were going to do a swing trade right now on one of these stocks, I haven't looked much for swing trades lately. Well, here, let's look at one of our favorite swing trades. So VIX. But what we really need to take a look at is VIX. When we do the VIX trade, which we've done twice in 2 years, we want to take a look at where is the actual volatility index. People look at this and say it's at a 52-week low. But remember, this is the new series. This line, this used to be way up here before they had to rebuild it after February of 2018. This has natural deterioration. The volatility index doesn't have any deterioration. It's just a measurement of an index. So anytime this gets down to around 12, it's very interesting, right? We bought it right in here, right in here. This is where we made the trade, and it spiked for us. And then the other time we did it, was way back in here. Did it in here. Some people made a mint in here. I'm a chicken. I sell in here. And you could have held it all the way up. So when volatility gets down a little further, 12-ish, back here we bought it. It was under 10 actually for a hot minute. But 12-ish to 10-ish, that's when you start saying, okay, I'm going to buy this ETF. But I hope you understand that you're buying based on this, and this just happens to be the price you get, right? This price doesn't matter. It doesn't tell you anything. This is what tells you when to buy. Because this is based on this. So you buy the VIX. When the VIX gets to around 12, that's when you can buy calls or sell puts on the VIX ETF. I will probably sell puts and then use that money to buy calls, right? That's called a synthetic long. All right. People are asking about First Solar. So First Solar and SunPower have both come down lately. On Monday, I'm going to tell people to start selling puts on SunPower. It's down low enough now. So the put that I am selling is the $9 December put, because I want to accumulate more shares in SunPower. I had a 1-2% position. I want to bump that up to 3-4. First Solar I haven't owned in a while. I was right. Came down. Now it's 50-ish. It has quite a bit of momentum to the downside. Take a look at the daily chart. Right? It's not quite oversold yet. Weekly chart still heading down. Just getting to oversold. The monthly chart tells a little different story. Just about at its bottom. So it looks like sometime soon you can probably buy a little First Solar, but remember, next year could be a rough year. If you buy First Solar in coming days or weeks, you're probably going to want to sell it again after it rebounds. So this could be one of our swing trading opportunities. All right, any other questions? I can see taking some profits on Tesla. I can. I think that they're going to be choppy now. Do they come back to under 200 ever again? I don't know. It's starting to look like not. So with a 220 cost basis, somebody mentioned, because we were buying it down. We actually bought it under 200 at a couple of years ago. And then I wrote that article 10 months ago telling people to sell it around, 340. I think you probably hit resistance soon. So again, you can ebb and flow trade it. Keep your core position. I don't know how much of it you have. Keep a core position, 1 or 2% of the portfolio, and sell the rest. And then add back in. If you're going to go 3, 4, 5, 6% positions. A 6% position, an 8% position in one company is very aggressive. So those 1, 2, 3, 4% positions is really what you're playing with. So keep that in mind. Risk management is very important. And if something bad happens to Tesla, you don't want to have 8% of your money suddenly turn into 2% of your money, right? It happened with our oil stocks, and we learned a very valuable lesson. Now, The reason I still look at the oil stocks is because I do understand them. I understand what changed. I wrote the article on Armageddon, right? Here's all the reasons why oil stocks are priced for Armageddon. We analyzed it. We figured it out. It was all these reasons. So when you put the recency bias out, right, it feels bad to lose money. People go nuts. Oh, everything must be fucked up. You know, sometimes things just don't go your way, and you got to figure out why. And the reactionary, emotional approach that, frankly, most investors have is what kills them. Everybody who subscribes to me or somebody else is trying to figure out a way to get good information and try not to be emotional about what they're doing, because intuitively we know buy low, sell high makes sense, but emotionally we want to chase those guys higher because we won't be the ones that fall off the cliff. Then we fall off the cliff, and instead of looking in the mirror, we turn around and point our fingers. If we control that, we're going to win. So understand why oil stocks really fell off a cliff. It's not because oil demand is falling yet. Someday that'll be true. We're probably a decade away. Yeah, we're going to figure out a way of, I think anybody on margin of safety who wants fundamental trends membership so that they can get the swing trading, yeah, it'll be cheap. It'll be like it'll be like $20 a month or $10 a month or something. It'll be super cheap. It'll be $100 a year or something. We'll figure it out. So if you are a margin of safety investor where we don't do swing trading, but you want swing trading, I'll give you like a $99. How's that? A $99 a year option. Be a member of Fundamental Trends. And for the couple of dozen people who switch from margin of safety to fundamental trends, I'll work it out with you too. But I would like to get these chat boards up and running again. I know that it was 20% of you that kept those running. Let's stay away from the politics, maybe a little baseball. Baseball's okay. But let's figure out how to do this. But let's keep this swing trading over at Fundamental Trends, because margin of safety, and I've had people scold me on this, margin of safety investing needs to be margin of safety investing. Fundamental Trends, we can go after the bigger fish. Margin of safety investing is largely going to be beat the market with lower volatility, higher growth, and higher income, right? And we'll beat the market by 3, 4, 5, 6, 7, 8 points a year on average, because that's what I've done for 25 years. And really, we just got our butts kicked on the oil. You throw out the oil and take a look at some of these other things we've done, and you're like, add up that income, and the slow drifts higher on some of these stocks. We just bought Invesco, and I laid out all the reasons why we bought Invesco. Right? We've been buying Invesco under 16. And I think a couple of people maybe bought a couple shares at 17. But it's paying 7%. They beat earnings the way I told you they would beat earnings, and they beat earnings for the reason I said they beat earnings. When they bought Oppenheimer, they're in the process of converting. They're in a transition period from that merger. People don't understand transitions. They bought Oppenheimer, got all those assets under management, are converting them to ETFs, and massively slashing expenses. And they haven't even cut their biggest expense yet, which is a whole bunch of those active managers. They're just going to keep the best of the best, and they're good algorithm guys. Invesco's got some of the best factor-based ETFs out there, and by the way, QQQ, which is pretty much the best diversified fund out there. All right, Calyx. I haven't looked at them in a while. Yeah, they just Oh, there you go. Are they gaining traction on their sales? That's the question. Has anybody read this one yet? All right, I haven't read this yet. Yeah, I haven't looked at this yet. But this is one that's been on our radar for, what, a year and a half? Sales did go up. Okay, I'm going to take a look at Calix, and I will report back on Monday. This might be on the sell put list. So again, every Monday, right around lunchtime, I'm going to have the the option selling update every Monday. We're also going to have Macro Monday, which I'll probably write on Sunday. So we're going to bring back Macro Monday, and then we'll have the option selling update. Then Tuesday, Wednesday, and Thursday will just be a topic, usually a company. And then Friday we'll do the webinars, and Saturday I'd like to have off, please. All right, margins look down at Calix. Yeah, I'll take a look. I haven't seen it. Let me run through. All right. Yeah, we'll figure it out. All right, you guys have a great weekend. We hit the hour mark on the nose, and keep an eye on these earnings, but pay attention to the expectations for next year. Are they lowering the bar on expectations? And ask yourself the important question: if they see flat earnings next year, but expenses go up because of the tariffs and because of slightly rising wages, and the corporations aren't investing a lot of money into the economy, and we know the economy is slowing down, right? All these things are lining up for an economic slowdown last year. Maybe a recession. I think a skip straight recession that I've described makes the most sense, but it all impacts valuations. The market moves on sentiment. So if sentiment pulls back, if fear increases, valuations will come down. Similar to at the end of 2018, and I think worse, but we'll see. Maybe the central banks aren't pushing on a string as much as I think. We know we're not going to get fiscal policy. So, again, I'm not in a risk-on mood. I think there's some trades that we can make between now and January, and we'll talk about those next week. I will put out the special for margin of safety investors for fundamental trends. If you've already moved from Mosey over to fundamental trends, I have a way of helping you get back to margin of safety. Seeking Alpha gave me a tool, and I'll post that in the Mumbo Jumbo chat room, okay, over at Fundamental Trends. All right, everybody, have a great weekend.